The Australian Treasurer, Jim Chalmers, has revealed that starting on the 1st of July 2025, tax on superannuation earnings exceeding $3 million will increase to 30%, which is double the current rate. And then for superannuation balances less than $3 million, the current rate of 15% will remain, which has stirred the pot quite a bit. Welcome back to my channel. My name is Reece, and in today's video, I'm going to explain some of these changes. I'm going to take a look at who is affected, and I'm going to try and cover the key points. The mandatory superannuation scheme was introduced in 1992, and its aim was to assist workers in funding and financing a comfortable retirement, whilst also decreasing the reliance on the current pension system, where through this compulsory savings program, employers are to contribute employees' salaries, portions of it, into dedicated superannuation funds. And since its inception, Australians have amassed a total of approximately $3.3 trillion in savings through this scheme, which is a mind-boggling amount of money considering our population is less than 30 million people. Where through this proposed adjustment, the government will generate an additional $2 billion in tax revenue annually ongoing. And this is where I want to hone in a little bit, because this is when it started to gain traction, people started to notice, and it made its way through the news cycle. It's the fact that the government are proposing changes to the very generous superannuation scheme because it was set up in a way that wasn't supposed to be touched for a very long time. The government anticipates that less than 80,000 people will be affected with this change, and I'll talk more on why I think that's not the most important part of this video. For now, most people aren't going to be affected by this proposed change, and some of those 80,000 people will most likely have the option to make adjustments and changes before that 2025 date begins and actually be able to do something with their money to make sure that it works best for them in that time frame. And this is actually a really good time to note that for affluent individuals, so I'm talking mainly rich people, the 30% tax break that they get putting money into their super fund is very generous compared to what their marginal tax rate would be for their personal income. If you don't understand what that means, don't worry, you're probably not in a boat where it needs to be understood at this point in time. The one-liner is that for really rich people, basically the superannuation scheme and contributing to their super fund is still probably going to be more tax advantageous than doing anything else with their money. They probably won't be able to get bigger returns anywhere else. Now, the way that it made its way through the news cycle is also very interesting. The way that it was presented was that these changes, or this change, would only affect 0.5% of the population, meaning 99.5% of the population would go unaffected. Unlike income tax rates, which I'm not talking about thoroughly in this video, I might mention them, but that's not the key point. Superannuation earnings, as long as you are employed, are taxed pretty uniformly. At the moment, they are taxed at 15%. And once an individual or person reaches the age of 60, their investment returns are actually taxed at 0% as long as there's less than $1.7 million in their super fund at that point in time. So again, as a one-liner or a key point, there is a massive incentive, especially for older people, to be contributing to their super and to be building that balance over time. Now, the way that these changes are being proposed means that there are two main factors that will be taken into account in order to perform the calculation to determine how much tax they're going to need to pay, or if they're going to fall into that they need to pay 30% tax versus the current 15%. The first is their superannuation earnings for a single financial year. And then secondly, the proportion of those earnings that are above that $3 million threshold, which may sound a little bit confusing. So I'm going to dumb it down and make this as simple as I possibly can. The calculation for their tax liability will be the following. It will be 15 cents multiplied by their superannuation earnings multiplied by the proportion of earnings above $3 million. And that's as far as I'm going to go with the calculation, because realistically, an accountant will most likely be the person who does that math for you if you're in the boat where you're managing a super portfolio that exceeds $3 million. One fun fact is, at the moment, if an individual makes a loss in a single financial year, they can actually carry those losses forward to be deducted in a future year of investing where you might actually make some money, and they can, help lighten the load of the tax burden that you might have to pay. There was actually an example posted on one of the sites. I can't remember where I saw it, but this was looking through the imaginary world of a person named Warren. He's 52 years old, and as of July 1st, 2025, he has $4 million in his super account. He makes no contributions and no withdrawals in that financial year, and by the following year, July 1st, 2026, he now has $4.5 million in his super fund because the investments actually made him money out of it. So Warren has earned for that financial year $500,000, and his proportion of earnings corresponding to that $3 million mark is 33%. And to work out that 33%, it's pretty straightforward. You just do the $4.5 million that he has in the bank and you subtract the threshold being $3 million, meaning he has $1.5 million in excess of that $3 million. And how much did he earn in that financial year in this hypothetical scenario? He earned $500,000. And so if you do the proportion of $500,000 to the excess of $3 million being $1.5 million, you just do $1.5 million divided by $500,000, you get 33%. So Warren's tax liability for the 2025 to 2026 financial year would be that 15 cents on the dollar being 15%. That's the first step of the calculation, multiplied by 500,000 because that's what he earned in that financial year, multiplied by that 33% value, which is the additional proportion above $3 million. And if my numbers are correct, he should have to pay about $24,750. And I want to be very clear here, additional to any taxes he already has to pay. So he would pay an additional $25,000 in tax basically, which is pretty significant for someone in that boat. But if you made $500,000 in a year, I don't think you would be complaining all that much. One other thing I'd like to note is that there are a few other calculations as well that I'm not going to go through right now because they're a little bit too complex and not really worth going through in this scenario. But basically, they are for self-managed super funds as well as carrying losses over. I can't be bothered talking about it right now. It's not going to be that applicable to most people. Just understand that there are some other factors which may need to be considered if you were someone who was for some reason watching this video and not just here for entertainment purposes and trying to actually learn how to do these calculations. There are a few others that may potentially be applicable to your scenario. All I can say at this point in time is that if you are someone who's falling into this category, have fun paying bucket loads of cash to your accountant to work out these numbers. And also for everyone watching, just understand as well, at this point in time, at the time of recording this video, there is still no limit as to how much money you can have in your super account. Now, if you are someone who is going to be affected by this and want to take action and do something against it to spite the government for whatever reason, just note that there are a few ways known as conditions of release that you will be able to withdraw all of your super and actually take it out and do whatever you want with it based on you meeting some of these criteria. I'm just going to name one, and it's the most simple one, is that you have reached the age of 65 and you haven't actually retired yet. Personally, the reason why I would say maybe don't do this or consider not doing this is that the intent of super was to build wealth over time and to reach a point where it becomes self-managing, so you can take out a small percentage of the earnings that you earn each year to make your way through the rest of your retirement. Withdrawing a large sum of money at once to do things with is technically not meeting the intent of what super was designed to do. And for me personally, this is where I take it all the way back to the very beginning of the video where I said that this is not about the small change or the small number of people that it's going to affect. This is the government proposing changes to a system that is supposed to fund people's retirements. The bigger question is that what future changes may they make that will affect everyone, a broader number of people, young people, who knows? And that's where it's a little bit scary. I'm pretty keen to see how this unfolds because I think it's relatively interesting that they are proposing changes to this system, which, like I say, if they make it harder for people to save for retirement, it will be less of an incentive for people to go down that path. And if the government is greedy and decides to take money from people who are doing the right thing by keeping their money in their super balances and by growing them so that they are not needing to rely as heavily on things like the pension, like I say, I'm very eager to see how they tackle these changes in the future if they do decide to propose more. that is pretty much all I wanted to cover in today's video. I hope it was insightful. It's pretty interesting. I think that there's some good key points that came out of this video in particular. It was a good oversight for myself as well. If you enjoyed, please consider hitting that like and subscribe button down below. I really do appreciate the support, and it definitely goes a long way for the channel. So thank you if you did take the time out of your day to quickly do that. And I'm going to leave you there. So have a good day, have a good week. And as always, I hope to see you in the next one. Bye for now.